Welcome, everyone, to the Retirement Power Hour. My name is Joe Allaria. This is episode 20. And today I'm going to be joined by Jay Waters, wealth advisor at CarsonAllaria Wealth Management. Jay and I are going to be talking about the biggest pitfalls in evaluating your investment returns. This is all prompted from a listener question that we'll get into in just a moment. But first, don't forget, go to retirementpowerhourpodcast.com. Tons of resources there. You can submit a question that we can respond to you on, and we may feature it on a future show. And don't forget, click Work With Me if you want a free retirement analysis. The first step is setting up a phone call with me. We'll talk about your situation. I'll ask you a few questions. I'll see if you could potentially be a good fit and if we can help you. And if so, we will give you that free retirement analysis and help you answer questions like, can I retire? How much can I withdraw once I retire and not run out of money? What accounts should I be withdrawing from? How can I pay less in taxes? How can I get more money to my kids in a tax efficient manner? All of those types of questions will help you answer those. Medicare, Social Security, the list goes on. So you can click Work With Me and take that first step. Just schedule a no obligation phone call and you'll talk with me. We'll have a nice conversation and we'll go from there. With that, I want to go into our listener question for this episode. And the question comes from Mark. And Mark says, I'm a bit unhappy with my returns over the past couple of years. I just retired. I was planning on a higher average return than what I've seen, and I'm unhappy at the moment. Just curious, what should a retiree expect in terms of average investment return? Well, Mark, it's an interesting question. And because that answer can go so deep, I wanted to just make today's entire episode about this question and go more in depth, because if you look at things the wrong way, it can really steer you the wrong way. You got to have the right perspective. So what I'd like to do is bring Jay Waters on as my co-host and guest today. And we're going to talk about the biggest pitfalls in evaluating your investment returns. And Jay is a fellow wealth advisor here at CarsonAllaria Wealth Management and is my periodic co-host. So we'll bring him on. Jay, thank you very much for joining me again and helping me out.
Yeah, absolutely, Joe. Looking forward to it today.
So we're talking about returns, Jay, and the biggest pitfalls and really how to properly evaluate your investments. The reason that we're doing this topic is because I've had many conversations, I know you've had some as well, where you hear people make comments about their investments. And it might be that they've had investments elsewhere with other advisors or in their 401k or somewhere else, and they're just really unhappy. And before I automatically start throwing stones at other advisors, I really try to dig down to the core of what the issue is and see if they're even being realistic or being fair to their current advisor, their current investments. So I've heard it so many times that I figured, hey, let's just talk about this and let's make this a topic on the show. So what are some of the things, Jay, that you've heard people say, some comments that you've heard people say in regards to returns? I have a couple here, but what are some that you've heard and you know right away when they say it that they're probably not looking at their investments right and they're probably not evaluating them fairly?
Yeah, they'll, a couple things you always hear a lot is, my 401k hasn't done well in the last 2 years. I must not be invested well, or I'm in the wrong funds, or my neighbor is up more than I am for this year. What's the reason? I must be invested wrong. Hearing those things, and the important thing is to not hear or not spend too much time focusing on what other people are doing or what the news may be saying or what other people might be invested in. It's focusing on how you're invested and what it compares to actually what the rest of the market's doing.
Yeah, it's a lot of apples to oranges comparisons is what I see. And it all comes back to setting realistic expectations. That's my true belief. It's not that I'm trying to, protect any period of time where we might see poor returns in some of the investments we use, but that's just part of investing. You're going to have ups, you're going to have downs. And if you're going to invest in something, you should set realistic expectations on, I think, the time frame for when you need to evaluate. I had someone say to me one time too that, and it was during 2022 that, well, the neighbor one, my neighbor or my relative, their portfolio was actually up 1% and ours was down. Well, most of 2022, the market was down, stocks were down, bonds had their worst year ever. So I said, well, that doesn't really mean anything to me without knowing what they're invested in, they could have been in CDs paying 1%.
Yeah.
So you're just looking back a year. I said, well, let's look back the last 7 years or 10 years to see how things have done, because just looking back 1 year in the stock market, it's not very useful. It's not very reliable. And I just made this point the other day to a client. If you look back 2 years as of the date we're recording this podcast, it's May of 2023. You look back 2 years, the S&P 500 is negative. Should we just say, well, yeah, the S&P 500 is trash?
Well, no. And it's the combination of the two. It's comparing what the investment should do, and then also how long you should give it to do what it's supposed to do. Giving it enough time also, right? Not saying, okay, I'm going to compare the S&P for 1 year and another investment based off 10 years, right? So it's the time horizon and the investment class itself.
We would certainly not say the S&P is trash. We're going to share some data on that. And on the flip side, again, in 2022, where the S&P 500 was down approximately 18%, bonds were down approximately 13% and some change, the bond market. And your checking account, let's just say, earned 0%, but it was the best out of those three. Would anyone in the world say that your checking account's the best investment ever? Because you never lose. I mean, maybe some, but when people know when they're investing to make money, you're not going to say, I know my checking account's the best place to have money to invest it. Well, it was the top performer in 2022 out of those three that I just mentioned. So I need to make this disclaimer as well. We're going to share some historical returns and some data that we've received. We got our data from Dimensional Funds. They put out some material for advisors. So we've compiled some of that, and some we'll share with you on our screen. If you're watching this podcast, if you're listening, we'll just share with you what we're looking at. But none of this, past performance is not indicative of future results. We get that, and that disclaimer is on about everything that we have. Now, and I'll say this, I think you can look at the past and you can start to gather some evidence. Nothing is guaranteed. It's not like the last 10 years is going to repeat the next 10 years. That's not going to happen, and we know that. But we can look at the past, and if you have enough data, you've got enough different types of time periods where interest rates were up, down, going up, going down. You had wars, you had recessions, you had all sorts of different types of events going on. The more data, I think you can start to at least gather evidence for how markets act. On the topic, Jay, of is the S&P 500 trash? I don't think many people would say that. We looked at 5-year, 10-year, and 15-year average periods, average returns. So every 5-year period, every 10-year period, and every 15-year period. And that went back all the way to 1926. And what we found was the average 5-year return. If you looked at 5-year periods, the S&P was up 10.29% on average. The average 10-year return, 11.03% per year. If you looked at it 10-year blocks of time.
Yeah. Yep.
And then 15-year, the average 15-year was 11.33%. So is the S&P trash? No, but it was negative the last 2 years. So that should tell you right there, if I'm only looking at a 2-year period to evaluate the S&P or any investment, evaluate my mutual fund, evaluate this stock strategy that I have. I put together a stock strategy, or an advisor put together a stock strategy for me. I'm 2 years in and it's negative. Does that mean it's bad? Well, we just said the S&P is down over the last 2 years. So it's really tough. I mean, my personal belief, Jay, is 2 years is not nearly enough time. We use the number 10 years. And that's not even a guarantee, but it's a much better metric, I think, based on the historical evidence of what we found.
Yeah. And the whole point of the historical evidence, again, like you said, it's not a guarantee of future performance, nor could it repeat itself. It just, again, it helps groom and get you used to understanding what can happen, what has happened, and what almost could be expected in certain cases, because the market has gone up and down over the years, where people become uncomfortable when they see the market down over 2 years. Well, if you look back over the last 80, 90 years, it should be expected. It's coming, here it is. Like, okay, I knew this was a part of it, right?
Yeah. It's possible. We have to know that it's possible. I don't like it. I'm not saying, I know you're not saying that you should like it and just be, like happy and comfortable. There's a difference between being completely caught off guard and panicked and just being mildly annoyed and understanding is part of it, but not super happy. But again, it's not the fund. It's not a bad fund. The S&P 500 is not a bad index. There have been funds that have down. Doesn't mean they're bad funds. It might mean you're not giving it enough time to evaluate. But how much time do you really need? How much time does the S&P need? Now, I said 10 years. Let me explain why I said that. And we use that. We talk about a bucketing strategy where short-term, mid-term, long-term investments, you have to figure out how much you need to be putting in each bucket. And that long-term we define as 10 plus years. And this is why. So if you look at the S&P 500, how many times has the S&P 500 been negative? If you look at even 5-year periods, we looked at 93 different 5-year periods. So starting from 1926 to, 5 years from there, 1927, 5 years from there, 1928, 5 years. And if you evaluate all of those 5-year periods, there was 93 of them. 12 out of 93 were negative, 12 out of the 93. So that's about 13% of those periods. You actually saw the S&P down after 5 years. Some people think, geez, 5 years, that's an eternity. Well, we call that the midterm. We don't even call that long term. If you go to 10 years, we evaluated 88 10-year periods. Only 4 of the 88 were negative for about 5% of the time. So 95% of those periods, the S&P was positive. Those are 10-year periods. And this is just the S&P. I want to stress that too, because we don't recommend investing just in the S&P 500, and we're not making any investment recommendations on this podcast either. So keep that in mind, but we don't recommend that. We're talking about the S&P because people talk about the market. So 95% if you give it 10 years. Now you go to 15 years, there's never been a 15-year period where the S&P is negative. Now we have to be realistic sometimes and say, well, 15 years, that's a long time. And so we use 10 because 10 has a pretty high probability. And especially if you look at a diversified portfolio, which I have here, and our diversified portfolio data only goes back to the 80s because, you didn't have emerging markets prior to that. International data wasn't as easily accessible. But if you look back, the worst 10-year period going back just to the 80s in a diversified portfolio was around 3.5% per year. And that was 1999 to 08. And so the only reason that was so bad is because you had 2008 was the last year. So you were doing pretty fine. You were doing fine. And then you had 08, and that took your average 10-year return down to about 3.5. But obviously that's a black swan type of event that we hopefully don't see very much in the future. But that just gives you some perspective. If you look at all the other 10-year periods, returns were higher. They were positive. So that's good. If we look at 5-year periods in diversified strategies, we had one 5-year period where the diversified portfolio was negative. This is not our portfolio. This is an index provided by dimensional funds to kind of imitate a globally diversified portfolio with large cap, mid cap, small cap, growth value, international, emerging markets, and real estate. So we're just kind of using this as a benchmark. This is not our portfolio returns, but that's some evidence for using 10 years.
Yeah. Another point to that is on when you look at the 5-year, 10-year periods on the worst case scenarios, when you look at just the S&P 500, when it was down 10 years, so those 4 times, the worst case of those 10 years, looking back in history, it was only down 1.4%. So again, that uncomfortable, doesn't feel great. If you look 10 years out and say, okay, I'm down 1.4, again, not great. But if that was the worst case out of 88 different testing periods,
right?
It's not like it's down 10%, 11 or 12. It's down 1. On the diversified side, when it was down over that 5-year period, the worst case, starting in 2007, it was down 0.01%. So barely down. I mean, it just barely missed the mark.
No, we're not happy about that. We don't want to see that. I hope every one of my clients, averages 10% a year for the rest of the time, but we just know that's not likely going to happen. And we have to take the ups and the downs. Now, going back, I've heard people say this, my 401k is no good. My IRA is no good, or my advisor, I'm just not happy with returns. And a lot of times they're going back 2 years, 3. I'm like, how long have you been working with them? Or why do you say your 401k isn't doesn't grow for you. Well, it hasn't grown the last 2 years. And if someone said that today, I would say, well, the market hasn't gone up. The S&P 500 is negative. Not that I'm trying to dissuade people from working with us, but right off the bat, I want to set the tone up front that we have to be realistic. And I'm not just going to go along with what you're saying if you're unhappy with your advisor or whatever, because then you're going to do the same thing to me.
Yeah, it's
2 years later. And I'm going to make sure you understand right up front, that's not a good way to evaluate investments, because again, I just keep using the S&P 500. It's a negative the last 2 years. Is it a bad investment? Absolutely not. It's not the only thing you should invest in. You need to diversify, but it's not bad. And the same thing goes for bonds. I've heard this so much about bonds for last year, because bonds were down. The bond market was down 13.1%. It was the worst year ever for bonds, Jay, and you know that too. But
Yep.
The worst year ever, and people are saying bonds are a terrible investment. Well, 2022 caused the first 4-year period where bonds were negative ever. So before that, we had never seen a 4-year period where bonds were negative. Because of last year, we now have one on record. Again, how negative were they over 4 years? 0.2%. Over a 5-year period, we had never seen bonds be negative. Because of last year, now we've seen one. How negative were they? 0.5%. So that's with last year on record. So what usually happens when stocks go down and bonds go down so dramatically, then the next year, sometimes, they'll rebound. It's all about the right expectations and just setting the right expectations up front. If you're investing in stocks for a day, I'd say, well, just go to the casino.
Put it on black at the roulette table.
Go to the roulette table, because you're just gambling. And I would say the same thing over, using stocks for a period of 1 year, expecting them to go up every year or every quarter, or worse, every month. When you get your statement, you expect to never see a negative number. It's just not realistic. And Jay, I'm a mild sports fan. I used to probably be a better sports fan, but we see this in sports, and people that watch football, basketball, and hear about coaches that get fired. Sometimes this topic has come up just casually with friends, is that when college coaches are hired or professional coaches are hired, football, basketball, the time that they are given to sometimes turn a losing program into a winning program is so unrealistic. And they get fired a year or two in, or maybe they won a championship even, but 2 years later, they're struggling a little bit. And these people are getting fired. One coach I want to mention, Mike Budenholzer, I think is how you say it. He was the coach for the Milwaukee Bucks. They won a championship 2 years ago. And it was the first title they had since 1971. And they didn't win the championship this year, and he's fired. I mean, again, the expectations are absolutely ridiculous. Again, in sports, that's just an analogy, but we do the same things to our stocks. You're just setting yourself up for failure. These owners, these heads of universities, they're just setting themselves up for failure. They're just being unrealistic, trying to get a quick fix, trying to get a quick turnaround solution. And unfortunately, all these things take patience.
Yeah, there's almost that expectation or that feeling of that one coach who got them there. I don't know how long he was a coach for, but it'd be interesting to see how long he was a coach for to then when he won the championship. And they probably, again, it's easy to set the expectation of, well, you did it that quick. Why didn't you do it again the next year and the next year? So again, it's just as important to look at how you got there, but also what the history was on, okay.
Well, I happen to have that information. His record, 271 wins, 120 losses, 5 division championships. His worst season, he was 46-26. His last season, he was 58-24, a 70.7 winning percentage, and it was the best in the NBA. I mean, if I'm this guy, I am like, I don't know what you want from me. What else? They had the best winning percentage in the NBA. Not to divert too much, but it's a great analogy, because I'm telling you, people do the same thing with their investments. They'll say, I don't understand why I'm not getting 7%. I just don't understand that, and I'm unhappy.
Yeah.
You're like the owner who fired the winningest coach, last season because he didn't win a championship. It's just not going to happen every year. But if you just sit tight, at least historical evidence has shown that markets rebound. And on that point, if we say the S&P 500, if it's averaged 10%, take a guess, Jay. You know the answers to the test here, but how many years out of 97, if the market averaged 10%, how many years do you think we have actually seen a return around 10%, say 8 to 12%? What do you think the average investor thinks? How many years? Of 97 years, how often do we see that return? If it's averaging 10 from 8 to 12%.
I'm going to say 7 to 10 would be probably what most people think. Probably maybe more than that.
I think the average investor probably thinks it happens the majority of the time. The less, historical data they might know, I think they'll probably say, yeah, I think it happens most of the time. But 6 years, we saw a return of 8 to 12% in the S&P. So that just goes to show, even though that's the average, very rarely are you going to see that. And what else does that mean, Jay? You're going to see some years that are way above. And I've got this here. So you're going to see some years that are way above that average, and some years, plenty of years that are below that average.
Yeah. And I know there's a piece later and we'll touch on it, but it's when talking about really great years, really bad years to then get that average is making sure that you don't miss out on those great years, because it can bring down that average so much if you are not there for those good years to actually have that average over time.
And here's that piece that just shows, these are all the years, only 6 years have we actually seen that 8 to 12% even, to give you a little bit of a range. And the other thing I want to mention too is why setting expectations is important, because sector returns are very cyclical. So getting in the weeds a little bit, but it's talking about different sectors of the market, different parts of the market. There's value, there's growth. These are how companies and stocks are sometimes categorized, right? So this is a piece from Dimensional Fund Advisors. And what we're looking at is from 1926 to 2022, value companies have outperformed growth companies by 3%. Value's up 12.7% over that 96 plus years. Growth's up 9.7% over that 96 plus years. Okay. That makes sense. But then we see from 2017 to 2020, we saw value was negative 3.1% during that time, and growth was up 17.6%. That's a huge difference. And I remember some questions about why are we holding these value funds, because it seems like growth stocks are much better. And the thing is, sector returns are cyclical, and we had to set proper expectations. So anything in the stock category, we put that 10-year label on and say, well, we don't get too excited before we hit 10 years, because things can happen inside that 10 years where these cycles can, come and go. What we found after 2020, if you look at July of 2020, to December of 2022, value was up 28.7% and growth was up 6.6%. It totally flip-flopped. But if you just base your decision on the 3 years, July 17 to June of 2020, then you missed out huge. You put all your money in growth, and look how you would have done from 2020, mid 2020 to end of 2022.
Going back to your neighbor or another advisor or whatever it may be, if they were all growth in that, right? Your neighbor, whoever could be maybe been all growth from 2017 to 2020. In the short run, they may look like a genius, and most people like to talk about returns when they're up. No one ever brags when they're down, right? You never hear your neighbor next door saying, if they were all value, saying, hey, we were down 3% last year. Isn't that great? Next door neighbor's going to say, well, I was up 17. Well, that next year, you give it the next 2.5 years, that same person is not going to walk out their garage and then brag anymore, right? So it's making sure you are comparing apples to apples, not apples to oranges. And it's also so important on having a diversified portfolio. The worst cases be you go look at 2017 to 2020 and you look how well growth did, And then you say on the tail end of it, you go, man, look how great growth's done. I should just put all my chips there.
Yep.
And then
you miss out.
Then you miss out on all that value for those next 2.5 years. And sadly enough, you see people do that sometimes.
And with rates being high now, Jay, similarly, it's like, why wouldn't I just go put all my money in a CD? I can get
5%,
4%, 5% in a CD. I'm okay with 5%. Why not just go do that? Well, I think it depends what your goal is. If your long-term average return goal is 5%, Jay, that means, again, some years you'll have to get more than 5%, because some years you're going to get less than 5%. We just play through those scenarios. All right. Well, let's say you get that CD right now and you hold that CD for the next 12 months and it's paying you 5%. But let's say the market goes up 20% during that same time. Then you didn't get that 20 because you only got 5. And then at the end of the 12 months, CD rates have come down. Now they're back to 2%. Now you're looking at, well, where should I put my money? I guess I'll put it back in the market. Things are better now and I'll put my money back in stocks and bonds. Well, you just missed 4 years of returns at 5. If you want 5% a year, the market went up 20%. You got 5%. So you missed out on 3 additional years sort of returns, and you need those. This chart shows that. And we're looking at it. If you're on YouTube, if you're listening, what we're looking at is a chart that talks about how much your rate of return will drop if you miss the top days in the market. Jay, I'll let you talk through this.
Yeah, it was kind of what I was touching on earlier on giving the time that it should be, staying invested, following through on the philosophy that was set in place to give it 10 years or whatever time frame should be set on what you're investing in. And on this here, so again, for those on YouTube or looking at it, is if you stay fully invested on an investment of $10,000 from the years of December of 2007 all the way to December of 2022, you'd have $35,000 if you invested $10,000. If you missed the 10 best days in the market, you'd have almost half of that. So about $16,000.
And talking rates of return too.
Yep. From a rate of return on the average, so for over those 15 years, if you are fully in the market, never miss any of the days, you're going to average based off this data, 8.81%.
Yeah, that's what historically.
Yeah, if you miss the 10 best days, you'd be all the way down to 3.29%. You miss the 20 best days, and the return goes negative.
That was just pause there for a second, because that is incredible. That's an incredible stat. You're in there the entire time in this 15-year period. If you were just invested the whole time, you got 8.8%. You miss just the best 10 days, it drops 5.5%. It drops down to 3.29%. But if you miss the best 20 days, that's not even a month, but the best 20 days, your return went negative. That's incredible to me, Jay.
And I was trying to do some quick math without accounting for holidays and federal holidays and when market may be closed, is over those 15 years, there's probably approximately between 3,700 and 4,000 trading days. So if you just miss 20 of almost 3,700 trading days, which is a very small percentage of days, it makes it that big of a swing in percentages returns. And
this is probably tough, because I think this is showing the literal best 10 days. So I don't think they're showing the 10 best successive days, if that makes sense. I don't think these 10 days were 10 days in a row.
Correct.
But yeah. I think these are the best 10 days. But still, Jay, I mean, 5.5% is astronomical in our world. I mean, 1% difference makes a huge difference when you're talking about hundreds of thousands or millions of dollars. 1% in return. That's why our job is we just help people. We want to get what the market provides and avoid these major mistakes and missteps. And we're talking 8% difference on the best 20 days. And I've unfortunately seen and talked with people that they were out of the market, and they not only missed maybe the best 10 day. I mean, they've been out for years And so they didn't maybe have all the bad days, but they missed such a run up in stocks because they're scared to get back in, and they know it. And they know that, maybe the amount of money they had, they should have double, triple what they have. But they've been out for so long. They've been waiting for the market to revisit its 2008 levels, and it never has. And some people now are waiting for the market to revisit its 2020 levels. And as of right now, it just hasn't done that. But a few more comments on this topic, things that we hear. If the market goes down 20%, someone will say, it has to come back 25% just to get back to where it was. And a lot of times this is a sales tactic that certain people in the industry use to drive fear, and maybe sell insurance products. We just did a podcast last episode on annuities, but it's very easy to spread fear. And so that's a great way to do it. Well, if the market's down 20%, it doesn't have to come up 20, it has to go up 25% to get back to where it is. And that's just percentages. Well, that's exactly what the market's done. You look at this data, it's exactly what the market's done. And then some, because the market has continued its uptrend over the last 100 or so years that we've tracked it. You also hear this time is different. I've heard that a lot lately, Jay.
And in comparison with this time it's different. It's usually in comparison to some, whether them being older, getting ready to retire, maybe in their mid or late 70s, this time it's different. And with that, it's different. And I don't have enough time for it to rebound, or I don't have, I can't let the market go down. I'm too close to this. So what do you say when someone says, I don't have enough time for the market to recover? I'm getting ready to retire. I have to go to cash. I'm getting ready to retire.
I just say,
I'm in my 80s. I don't have 10 years, right, for the market to come back. So what do you say to clients when they say something like that?
Yeah, I do. I say, do you think there's a chance that you could live 10 years? And it is way different. If you're 60 years old or 65, I think we have to assume you're going to live at least 10 years. Unless you have a terminal illness. So let's talk about that person first. We're going to assume you're going to live 10 years. And not only that, you're going to need some of your money at 75, at 76, at 78, at 80. If you're still alive, you're going to maybe be taking withdrawals. So if we want to invest that in the most prudent way for that time horizon, we feel stocks or stock funds are the best way to do that. So we'll talk about these numbers. So the worst, if you look at in a diversified portfolio, the worst 5-year returns, because people say, I might not have 10 years. Well, if you look at the worst 5-year returns, where we talked earlier, 2007 and 5 years later, so it'd be 2007 through 2011. So 7, 8, 9, 10, 11. That period was 0.1%, negative 0.1% in a return, a diversified type of portfolio. If you just waited 5 more years, the return goes from negative 0.1% per year to 5.8% per year. And the next worst 5-year period started in 2004. Over that 5 years, the average was 0.8%. If you just waited 5 years later, so you got to 10 years, the average jumped from 0.8% over 5 years to 9.3% over 10 years. So we just encourage people, just keep the proper perspective on these things. Keep the proper perspective, because the numbers, you can't say these things are guaranteed, but it is a lot of historical evidence. It's a lot of context, a lot of different time periods. And I think it's helpful for those people that are 60, 65. Now, if you're 85 years old, and we've had conversations with folks that are 85 and they say, I really may not be here in 10 years. I would say that's fair. So we may not want to use stock funds, because if our rule is 10 years, then maybe we go to a more midterm investment or a shorter term investment. Midterm investments like bonds, or shorter term investments, even like CDs. It just depends the situation. And then where's the money going to go? If they're not even going to use it, it's going to go to their kids, and their kids won't need it for the next 5 or 10 years. Now you kind of are looking at the time horizon of the kids or whoever will inherit that.
Just exactly what you said. I'm glad you touched on it. Was don't base your diversification or how you're invested just solely based off age. Look at it as what the distributions are going to be. What's the purpose of the money? Again, because for an 85-year-old, like you said, again, you hit it spot on, is do you need it? What are the distributions needed? Or do we look at the kids and say, when do they need it? Because that is going to determine, okay, you may not have 10 more years to live. Sadly to say, you may not have 10 more years, but your kids are in their 50s, they'll probably live another 20 or 30 years, hopefully. So look at it from that way too.
Well, I wish we had more time. We've covered a lot of ground, and unfortunately, we're going to have to wrap this episode up. But I think the theme here is don't compare apples to oranges. Just don't compare apples to oranges. Have the right perspective. Understand and the proper expectations on the type of investments that you're using before you try and start evaluating them. Because if you have the wrong perspective, you could start labeling good investments as bad investments, good advice as bad advice, because you're just not looking at it in the right amount of time and you have the wrong expectations.
Let the apple ripen, right? Don't compare it to the orange, and let the apple ripen.
I always use the example of baking a cake. For some reason, I don't bake cakes, but if the cake needs 30 minutes to bake, don't go in the kitchen after 5 minutes because you're smelling it and you're hungry, and just take it out of the oven and take a bite. No one in their right mind would do that and expect that cake to taste right. I use that analogy and everyone just kind of laughs and says, oh yeah, no one would ever do that. That's exactly what people do with their stock funds.
Yep. Absolutely. Good point, Joe.
So if you have questions, you want a free retirement analysis, you're getting close to retirement, you don't know, can I retire? How much money can I withdraw from my portfolio without running out? How can I save money on paying taxes, pay less in taxes, I should say? You don't know the answers to those questions. Should I be doing Roth conversions? How can I gift money to my kids? All of these things. If you have those questions, go to retirementpowerhourpodcast.com, click work with me, tell us about your situation, set up an introductory call. You'll talk with me, and I'll just ask you a few questions, see if you're a good fit or would potentially be a good fit. If so, we're happy to give you a free retirement analysis where we will help you answer those questions, tell you where you're at, tell you where you stand, and hopefully provide some clarity for you. So go to retirementpowerhourpodcast.com. Also, if you just have a general question, you can click submit your question on that website, our website. Type your question in. We'll respond to you, and we may address it on a future episode. Last but not least, don't forget to leave us a review. If you're still listening, you must really like this podcast because we're deep into it. So if you're still listening, please go to Apple, go to Spotify, leave us a review. Tell us what you think. Hopefully you'll like it, and that would be greatly appreciated. That helps us get our word out to more people. With that, I want to thank you again, Jay, for joining us. I'm sure we'll have you back soon. Enjoyed the conversation. Yep. And for everyone else that's listening, thanks for tuning in. Don't forget, join us next time on the Retirement Power Hour, where we help listeners invest wiser and retire better. Take care.
Thank you for listening to the Retirement Power Hour podcast. All material discussed on this podcast is for educational purposes only and should not be construed as individual tax, legal, or investment advice. Investing involves risk of loss, and investors should be prepared to bear potential losses. Past performance may not be indicative of future results. Joe Allaria is an investment advisor representative of CarsonAllaria Wealth Management, a registered investment advisory firm. Information discussed on this podcast may be derived from third parties that are believed to be reliable, but CarsonAllaria Wealth Management does not control or guarantee the accuracy or timeliness of such information and disclaims all liability for damages resulting from such sources. Any references to third parties are provided as a convenience and do not constitute an endorsement.